Good morning, all. Good morning. Good morning. Just give you a few seconds to enter the room. Okay, so look, good morning, traders. It's wonderful to be back with you as we step into 2023. Hi, Travis. Hi, Travis. Look, guys, Happy New Year. First and foremost, Happy New Year from me and the FP Markets team. I hope we all had a restful break as we look, as I said, as we step into 2023. For those of you new to the webinars, my name's Aaron Hill, and I'm one of the market analysts for FP Markets. Now, as usual, there should be no issue with sound or the slide deck, as you can see on the screen here. If there are, do let me know, or do post a comment in the chat box, and the support team will try and help you out. It's fine to ask any questions during the presentation, but if it's something you feel that may require a more deeper explanation, it may be better waiting to until the end, or even maybe sending us an email. So we'll hand out the emails at the end of the presentation. Also, in terms of a recording, this will be recorded and will be available in two places. First of all, on our YouTube channel. So do make sure to go and subscribe there to receive any notifications. And also on our main webpage, and you'll see the links in the chat box there. So in the main webpage, we have a number of presenters from all different countries, so there's a lot to get your teeth into. All right, so disclaimer, guys, as usual, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Look, I'm not going to read through all of this, but in a nutshell, it really is telling you that this should not be considered investment advice. This is purely my view on the markets especially as we get to the chart. This is simply an educational presentation. All right. So let's kick off with a brief look at what occurred in 2022. So really the main global themes affecting the markets were, of course, elevated inflation, historical aggressive global policy tightening, and of course geopolitical tensions. And really these three have been the center of attention throughout 2022. So I will not go into too much detail here regarding geopolitics, as I'm sure we're all aware of what occurred in 2022. But in early 2022, the world witnessed Russia invade the Ukraine, and an unfortunate war that shows really little sign of abating. This, as well as the unfortunate loss of life, also saw a number of things occur as a result. For example, we had supply chain disruptions, as well as food and energy insecurity, and therefore subsequent market volatility. Now, as you can see in the small box in the lower right-hand corner, this is the global food price index. Now, the price of vegetable oils actually saw 23% following the onset of the invasion. Cereals were up 17% and sugar rose 7%. But you know, as I said, really we just have to look at the global food price index here. And we can see that price nearly hit one. It looks like it hit 160 here, but it wasn't. It was actually 159.7, I believe, which, according to my research, is actually the highest on record. And just to give you a little context here, from February to March, the index actually jumped a whopping 13%. And as I said, March was, as far as I understand, was the peak, and has since then, as you can see, seen a rapid decline back below pre-2022 March level. February levels. So just to give you more information regarding this food price index, it consists of five commodity indexes. Commodity price indexes, and it's the cereal price index, the vegetable oil price index, the dairy price index, the meat price index, and the sugar price index. Now, many European countries, as you can see on the chart, also rely on Russian oil and gas to of course, heat their homes, fill their cars, gas tanks, and power factories, of course. The conflict further fueled the worldwide inflation, and what it did was hike the price of oil and natural gas. We only have to look at the price chart of oil. This is the West Texas Intermediate WTI, and this is the daily time frame. So, as you can see, similar to the food price index, the price is rallied higher, dominantly pushed higher during this time. And as you can see, Thursday, the 24th of February is when Russia invaded Ukraine. So a few days after that, we saw a massive rally in the price of oil, which actually topped at a high of 126.35, and this was dollars per barrel. As you can see, though, very similar to the food price index, we have since topped out and we have seen a decline in price. Now, for any technicians here, you will note that this is almost a textbook downtrend scenario. We have lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, a series of lower lows and lower highs. And as you can see, look, when we're presented with the downtrend, technicians do believe that the trend will likely continue. So for the price of oil, I am looking at potentially lower prices for 2023, that is, for this year. Okay, as we move on to equities and bonds. Now, in terms of global equities and bonds, we have the FTSE All-World Index. We have the MSCI, this is the Morgan Stanley Capital International World Index, and the Vanguard Total International Bond ETF. Just to be clear, these charts were taken from the Financial Times website. So looking at this chart, it's safe to say it was an especially difficult year for equities and bonds, declining almost in tandem during 2022, and all ending in negative terrain for the year. So look, bonds could not act as an effective source of diversification as they traditionally would, as there was clearly a stronger correlation. Between the two asset classes. Now, the reason behind this correlation is largely due to the policy tightening regime that we have seen across major central banks. I will be talking about that shortly. Now, just to give you some context here, the FTSE All-World Index covers approximately an eye-popping 98% of the world's investable market cap. Now, this is according to the FTSE publications. Now, I think this totals to around 4,000 stocks in 50 different countries. Now, the MSCI World Index covers more than 1,600 securities across both large and mid-cap size segments in 23 developed markets. Now, finally, the Vanguard Total International Bond ETF is, as far as I'm aware, the largest bond ETF. Now, for holding details, there is a detail page on the Vanguard website if you're interested. Now, FP Markets, if you're interested in trading ETFs on both the MSCI World Index and also the Vanguard Total International Bond ETF, we do offer ETFs based on CFDs through our MT5 platform. So if you're interested, do pop along to our website and you'll see all the details there. All right, so global inflation. As you can see from this trading view chart, inflation levels for the UK, Europe, Australia, and the US experienced broad upside pressures in 2022. And this clearly remains an ongoing theme for the year ahead. Though what you will see from this chart, that for the 4 countries just mentioned, there are signs of a potential peak. Just bear with me. I want to get the spotlight on. There are signs of a potential peak, particularly in the US. Annual inflation, as you can see, for June of, I think it was June of, bear with me here, guys. I just want to double check this. Yes, June of 2022, we saw a peak at 9.1%. This is US annual inflation. And since then, we have eased for 5 successive months on an annual basis. And really, many are saying that this is the peak in inflation. Now, currently, we are at 7.1%. And just to be clear, this is really of note as well. Later today, we will see the latest annual inflation rate for December. And this is at 1:30 p.m. GMT. Now, the expected release value is 6.5%. So the markets are expecting another slowdown in consumer prices since the potential peak at 6.1%. Now, for the UK and Europe, the Euro area, for me, it's too early to tell whether these are peaks. Specifically, as I said, for these 2 countries here. The Euro area inflation currently is at 10.1%, with the UK at a whopping 10.7%, and this is really down from the 11.1% peak we saw in peak. I shouldn't have said that, but the reading 11.1% in October for the UK. So the bottom line really is, inflation is still a huge issue for the markets. Now, in terms of the central banks for 2023, as you can see, I've labeled the major central banks. I could have had the RBA here, the Reserve Bank of Australia, and the Reserve Bank of New Zealand, and the Swiss National Bank, but I've chose these 4 for this presentation. So we have the US Federal Reserve, the Fed, the European Central Bank, the ECB, and the Bank of England, the BOE, and the Bank of Japan, the BOJ. Now, just to give you a little bit of context in terms of when we're expecting the next interest rate hikes in 3 of these cases. So for the US Federal Reserve, the next meeting is on the 1st of February. And markets are currently pricing in a 25 basis point hike. And with the current target range for the federal funds rate is between 4.25% and 4.5%. So a 25 basis point hike will see us move up to the 4.75% range. For the European Central Bank, the current main financing rate is at 2%. The markets are expecting a 50 basis point hike, currently with a 79% probability. And this is according to short-term interest rate futures. So we are expecting a 50 basis point hike in February, and the exact date for that is the 2nd of Feb. For the Bank of England, now the Bank of England are set to take the stage also on the 2nd of February. So look, at the beginning of February, we really have a monster, week for central banks. So the Bank of England is currently, at current prices, is anticipated to hike by another 50 basis points. And the current bank rate is 3.5%. So that would drag us all the way up to 4% if that does indeed materialize. Finally, the Bank of Japan is still on hold, though as you can see on the slide here, though the recent widening of the yield curve, I'm sure you saw that in the markets, and the subsequent move in the Japanese yen. What this really does is indicates that policy could be altered, as you can see on the screen. The current policy rate still remains in negative territory at minus 0.1%. So yes, that's really it for the central banks. And finally, we're going to look at growth and recession for 2023. So look, our major economies heading into recession? And this is really the question. Some are saying that we may already be here, especially in the UK. Look, there was an awesome article put out by Bloomberg, and this was produced, I think, on the 3rd of January, about what all the major institutions are expecting for 2023. Now, and I will provide this link, as it does a far better job than I can do explaining what we can expect in terms of growth and recession. So what I'll do is I'll slam dunk this into the chat box for you guys, and let's see if this comes across. You should see this link at this point. So do have a look through that article. It's quite in depth, and but it will be something that I think will benefit you in terms of what the major institutions are looking for. All right, so technical outlook. As you know, as with many of these global themes, still, just bear with me, guys. I think I'm sharing the right screen. Guys, if you can just let me know if the dollar index is showing on your screen, just Y or N in the chat box, Y for yes. And that would help me out a lot. All right, excellent. All right, so, all right, thanks, Travis. Thank you very much. All right, so look, as I said, and with many of these global themes still ongoing for the 2023, market participants, they really do have plenty to get their teeth into as we step into this year. The technical space really offers several interesting scenarios. Now, just to be clear, although I did say this at the beginning of the presentation, these are my views and do not constitute investment advice of any kind. All right. So let's begin looking at where currencies are and where they are potentially headed for the year. So I will begin with the King dollar, the #1 most actively traded currency globally. Now, according to the latest BIS statement, this is the Bank for International Settlements, the US dollar was on one side of 88% of all trades. This is how relevant the dollar is in the foreign exchange markets. And just to be clear, this was unchanged from 2019. The share of the euro in terms of the foreign exchange turnover decreased marginally to 31%. And this was from 32% in 2019. Okay, so the dollar index. Now, the US dollar index, as you can see on the chart here, and this will often, the ticker symbol is, I think this is based off Bloomberg, DXY, Dixie. What it does is it represents a geometrically average weighted calculation of the dollar's position. And this is versus 6 major G10 currencies, and which includes the euro with the largest weighting at 57.6%, and the British pound and the Japanese yen. Following this, we also have the Canadian dollar, Swedish krona, and Swiss franc. Now, the index, as you can probably see from the monthly time frame, finished 2022 in positive territory, and it was up by 8.2%. Now, this was despite this eye-watering retracement, or spirited 10% retracement in Q4, following September's high of around 114.78. Now, to the left, we are working with the monthly time frame. So this is a very longer term time frame. So it's one candle per month for any new traders present. So out of the monthly chart, it's clear the index hit a ceiling in the shape of an ascending channel. This was extended from the high of 103.82. This was complemented by a picture-perfect negative divergence out of the RSI. This is the Relative Strength Index, which is an incredibly popular gauge for momentum. And what this did, I'll just give you a closer view. So what this did was land the dollar on the doorstep of a decision point at 101.40, 103.91. Again, guys, this is the monthly time frame, so it's a very long-term outlook here. Why this was a key area for me was quite simple. It was here that a decision formed to break this high, the 102.99 high, as well as the high that 103.82, the high that formed the ascending channel. So it was a decision point that was not based off of any resistance turn support at this point. So it was essentially in no man's land. And these tend to have a high probability of holding and rejecting price action. All right, so we are now within this decision point, and we did see a mild reaction form this month, so far this month, but it has really failed to gain much acceptance. As you can see, the upper shadow, we have a rather, obvious upper shadow present at the moment. So this is still a key area. It really is still a key area for the dollar. And we also have the RSI nearing the 50 center line. So we could even see the RSI dip lower to test this center line and potentially aid any rebound from this area. Adding to this decision point is, of course, the uptrend. We're in a clear uptrend. So we have been in a clear uptrend. If you really want to be technical, we could say we have been in an uptrend since early 08. We had a high, higher low, and subsequent higher highs and higher lows. So we are in an uptrend on the dollar index in the long term. So do keep this in mind as we move across to the daily time frame. And this is a slightly shorter term perspective, especially considering the comparing to the monthly time frame. And what we have is a number of interesting scenarios playing out. So on the daily time frame, we have what's known as a death cross emerging. So a death cross is when the 50-day simple moving average crosses below the 200-day simple moving average. Now, this is considered a bearish signal, and really what it indicates is, I emphasize the word indicates, it indicates that we could be in for a longer term downtrend on the US dollar. Whether this will play out is very difficult to say at this point because of where we are on the monthly time frame. This could be an ideal area to begin buying, in fact, because again, guys, this is my view. This is only and should only be taken as such. We are now between a support area, and this support is formed between a Quasimodo support at 102.36 and 103.42 support. I've highlighted this with a circle. We also have positive divergence forming on the on the RSI for the daily chart. So look, I do believe we could see buyers emerge from this area in the long term because we are bolstered by this decision point. This area of support is set within the upper range of this decision point. So this is why I am watching this closely, and this is why I am not too confident in this death cross here. Now, the opposite to a death cross, of course, is the golden cross, where the 50-day simple moving average crosses above the 200-day simple moving average. And this is a bullish signal. As you can see in this case, it worked out very, very favorably, as traders would have entered long at this point here and held all the way until we had the death cross at this point. So it would have been a very, very nice year for those, a very nice year and a half, in fact, for those long at this point here. All right, so that's where I am on the dollar. So if the dollar finds a floor within this monthly decision point, then it could really trigger a rally in the bug, and which consequently may weigh on its major counterparts like the euro. So remember where we are on the monthly time frame. We are in a clean and clear decision point at 101.40, 103.91 on the monthly time frame. Now, shifting over to the euro, this is a very basic chart here, guys. It's just where I noted some confluence emerging in terms of the technical picture. So You may recall that I noted that the US dollar index is calculated based on six major the dollar's value against six major currencies, with the euro controlling the largest weight, which is 57.6%. So what this means is when the dollar index declines, there's an inverse correlation to the euro dollar. As you can see, we have a correction form on the monthly time frame of the dollar index, but the euro is pulling back. So look, we can see it very clearly here. Clear downtrend on the euro in the longer term, a clear uptrend on the dollar index in the longer term. So we have a pullback forming on the euro dollar, which is approaching a reasonably tight area of confluence, technical confluence. So we have an ascending support turned resistance taken from the low of 0.340. Now, this is not a trend line, guys. This is not a trend line. A trend line is trend line's main purpose is to identify a trend. So we can have this area here. That's a trend line that identifies a trend, and it does not cut through previous price action, which this one certainly does. So, and this one does not. So that is a trend line. This is really why I labeled these ascending support term resistances, just to be clear. So we have this merging with a resistance at 0.884. And this is for anyone that has watched my Quasimodo supports, the Quasimodo formation webinars I did last year. You will remember, you may recall that this is a Quasimodo support turned potential resistance. Now, what this does is it merges with this ascending support term resistance, as well as a 50% retracement at 0.939. So we have some confluence here, some technical price confluence alongside the RSI, within striking distance of the 50 center line. So all of this combined, along with the dollar index in a trading within a decision point on the monthly time frame, and the daily time frame within a support area, I feel that we could see a bearish reaction form from here. Whether it will be enough to, write home about or get excited about is very difficult to tell, of course. But I do believe sellers will be looking at this location early this year. And if we do see a reaction, we could see a continuation lower in the euro dollar and a continuation higher in the dollar index. Okay, so in terms of the commodity space, I have on the chart right now the CRB index, which actually technically is called the Refinitiv. Is now called because it's gone through a number of name changes in the past. It's now called the Refinitiv Core Commodity CRB, I believe, or the Commodity Research Bureau Index. Now, to be clear, this chart really shows a basket of 19 commodities, which includes things like energy contracts. I think it's all based on the futures market. So it includes energy contracts, precious metals, agriculture, and base metals, industrial metals. And really what the index that the CRB does is act as a representative indicator of commodity markets. So as you can see, so look, just to be clear, there are other commodity indexes. There is also the S&P GSCI. That's the Goldman Sachs Commodity Index, and this is why this is another alternative that you can use. But this is more weighted towards the energy markets. In fact, I think it's approximately 60% weighted towards energy. So hence a strong correlation exists between that index and the oil markets. So looking at the CRB index, it's clear we have turned lower. Now, for anyone that follows intermarket relationships, if I compare the what am I looking for here? I think so. Yes, let's go with this one. Oops, I shouldn't have done that. Bear with me here, guys. I don't know what I've done there. There we go. Now, I think that's the wrong one. What I was trying to show is the stock market, so the S&P 500, which I will be touching on shortly. But what happens with intermarket analysis? It's usually between 4 different asset classes, and that's bonds, stocks, commodities, and the dollar. So what happens is the bond market generally turns lower prior, and this is followed by the stock market, which is then followed by the commodities market. And if you will note that the stock market actually turned lower before the CRB. Let me try and bring this up because I think it's interesting. Yes, here we have the bond market here. Let's get that up as well. The bond market. So let's get the dollar index as well. There we go. The S&P 500. All right. So this is really a really nice picture, I believe. So we have the bond market here. This is the 30-year Treasury bonds. 30-year Treasury bonds sell off, and later we have, I think it was 5 months later, we have the S&P 500 sell off, followed by the commodity market. And you will note that if I even add the dollar index, we also had the dollar index. Look at that. It's perfect. This is a perfect example of a intermarket relationship. So bonds sell off, followed by the S&P 500 or the equity market, followed by the commodities, and then followed by the dollar. So this is the dollar here. Just to give you a little bit of context, though, we are seeing a rally in the bond market. So right now, it's probably a little bit difficult to see. I didn't really plan to add all of this, but a little bit difficult to see. But the bond market has now started to rally, given the expectations that the Fed are expected to slow with their interest rate hikes. So the bond market has rallied. And with that, we may therefore see the stock market bottom out, followed by the commodities market, then followed by the US dollar. It's just something to be aware of, guys. I do apologize for diverging somewhat. But anyway, so the price action on the commodities, the CRB index, recently topped out at a major resistance at 325.31. This is a major weekly resistance, guys, that was complemented by negative divergence on the RSI. But look, for any price action based traders here, this will have been obvious that the upside momentum is starting to slow here. We did not really need the RSI to tell us that, but nevertheless, it did show a picture perfect negative divergence within overbought territory that, as I said, complemented this weekly resistance. Following this, we broke lower and we formed a bearish flag. I really do like this bearish flag because it's very it has a distinct pole to the downside, and it's very compact within the flags area. Look, we have been a bit sluggish to the downside. Look, I have put a question mark whether we are ranging between the 287 and 264. I'm not too sure. I still believe we are potentially headed lower on the Commodities Research Bureau. Because look, we nearly bounced off the lower edge of this range. We failed to, we hit about 50% of this range before pulling back yet again, and we're now testing this range again, the lower edge. But look, below here, I will be watching this support this year at 256.889. Following, look, if a break does occur to the downside, we do have a number of supports. We have the support at 237.47, followed by the pattern profit objective for this bearish flag. So these are areas I will be watching this year. Also of technical relevance, which I should have really highlighted, is we had a trendline support breach. Now, guys, remember, this is a trend line. It depicts the trend. What happened, though, is price has broken below this trend line support and retested the underside of this area as resistance. Very common scenario within the technical charts. So really, this is where I am for the commodity space. I do expect we could push lower and at least test this support this in upcoming trade. I did really want to, in terms of intermarket relationships, I know I did briefly touch on that just a few seconds ago regarding the four asset classes. I really think this is an interesting relationship for the year ahead, and that's between gold and US Treasury yields. Now, these do tend to work with an inverse correlation, and why that is should be really self-explanatory, because gold is a non-yielding asset. So when rates are on the rise, as we've seen as we saw in for the bulk of 2022, many believe that fixed income will be more attractive than gold, and therefore a move out of gold into fixed income will be seen. And this is what seems to be playing out at the moment. So let me zoom in, and this is just to be clear, this is a correlation coefficient indicator showing the strong inverse correlation between gold and US. This is US 10-year Treasury yield. So as rate hikes from the Fed are now looking to slow, we are seeing the reverse occur. Namely a move out of fixed income. As you can see, yields are on to the downside and gold is moving to the upside. So this is something to keep an eye on. You can also plot technical levels on both charts to predict support and resistance, as I did with the dollar index and the euro dollar here. It's just a correlation to be aware of as we move forward. I also really wanted to highlight the correlation between gold and the US dollar index, excuse me. So right now we have the US dollar index on the rally, and of course, as we already know, the dollar index is lower. This is a strong inverse correlation. Again, this is the correlation coefficient. Both correlation coefficients here are calculated on a 60-day rolling average, so it's based on 3 months, a 3-month average, if you will. So this is something to be aware of. Most of us are aware that the dollar index and gold are inversely correlated. Why this is the primary reason is the dollar is the pricing mechanism for commodities, right? So the US currency is the major reserve currency of the world, and so when it comes to international trade for the raw materials and commodities, the dollar is the exchange currency in many cases. So when the value of the dollar drops, it costs more dollars to buy commodities. At the same time, it costs a lesser amount of other currencies when the dollar is moving lower. Now, guys, there are a number of key intermarket relationships. Now, if you're interested in intermarket analysis, John Murphy is a very, very good read for this kind of analysis, in which he also uses relative strength, another fantastic way of analyzing strength in the market. So that's the outperformance and underperformance. And this is usually against a benchmark. All right, so on to equities. This is the S&P 500. So just really for equities, it was a pretty poor year in 2022 for FANG constituents. Now that's spelt FAANG, and this consists of the Facebook, now Meta, Amazon, Apple, Netflix, and Google. And look, Apple dropped a whopping 25% in 2022. Meta dropped 65% in 2022. Microsoft dropped, I'm just adding some different stocks here, the major stocks. Microsoft dropped 29%. Amazon dropped 49%. Netflix dropped 51%. And Google dropped 38%. So all in all, it was a pretty poor year for tech stocks. I do actually have a chart here of Amazon I posted, I think it was yesterday. I will show this because it does really highlight, I'll go over this first though, but I will go over the Amazon chart. So really, we can see for the monthly time frame for the S&P 500, we are in a clear primary uptrend. Higher highs, a series of higher highs and higher lows. There's not really much else to add to this other than we are in a correction right now in the primary uptrend. And this correction was aided by negative divergence out of the RSI. Now, if we move to the weekly time frame, this is where my attention really has been as we head, really will be as we head into this year. So right now we have a trend line resistance, clear-cut trend line resistance, all right, that's been respected, that's clear and obvious for everyone to see. We also have a support at 3589, again, weekly time frame, and we have the 50% retracement ratio at 3512 that has reacted to price. This trend line resistance is important for me for two reasons, really. We are in an uptrend, as we've seen, and a break of this trend line resistance here, which looks like it may occur given we are now up nearly 2% this week, will help reaffirm the primary uptrend on the monthly scale. So a break of this trend line resistance will be likely welcomed by especially dip buyers. And also on the RSI, we have an ascending triangle. Now, ascending triangles generally form within uptrends as a continuation pattern, but do be aware there are instances where this can form as a reversal structure at the bottom of down moves or down trends. And this could be the case here on the RSI. Just to be clear, the RSI, you can plot different patterns. You can have flags, you can have triangles, support and resistances, trend lines, and all that good stuff. So we have an ascending triangle at this point. If we break out to the upside, this will aid any breakout. This will help help confirm any breakout above this trend line resistance, and really, as I said, help confirm this primary uptrend. If we look over to the daily time frame, this is the far right chart. We have now broken above the trend line. We gapped higher actually above this resistance at 3921, and this is a sign that we could. This is an early sign that we could be looking to take on this trend line resistance. Another sign, of course, for any price action traders is the reaction from this trend line resistance was very, very substandard this time. This reaction and this reaction was strong reaction, very poor. And we have now the ascending triangle forming and this break of resistance. It does really tell me that the S&P 500 is potentially looking for higher prices. Now, what I was talking about for Amazon is this. Just bear with me, guys. Is this. We had a falling wedge break. Now, this is what's known as a breakaway gap. Now, this is the Amazon stock price. And we also broke above a trend line resistance. We closed above a trend. So we have a trend line resistance at this point that was closed above. We also have a breakaway gap above a falling wedge, and we have a major weekly support. Let's just click across to this weekly chart. This is a Quasimodo support. So we have a left shoulder high, left shoulder high, lower low, and then followed by a touch to the God, how many years was that? Nearly 2 years. 2 years ahead, we've seen a falling wedge form into a daily falling wedge form into a weekly support. So we have a lot of confluence here to say that the Amazon stock is potentially heading higher, targeting the potentially targeting resistance at 101.44, followed by a potential test of this pattern profit objective at 106.97. Now, just to be clear, the pattern profit objective is taken from this base value and extended from the breakout point. Now, textbook, I do not believe there are any recommended take profit targets for the falling wedge. This is why, but many do consider this to be standard now, according to what I've seen. Okay, finally, on to the Bitcoin. Really needs no introduction, does it? Bitcoin, the major crypto, has seen a really has pushed to the upside of late, and we are now attacking this resistance. This is the daily time frame, guys. We are now attacking this resistance at 18,099, which reacted well in mid-December. Okay, we are now above the 50-day simple moving average. Is this the start of a reversal to the upside? For me, it's far too early to tell, primarily because we are in a dominant downtrend. We have had a number of clear-cut bearish patterns form, and we still have the bearish pennant pattern at this point here actually completed, or not completed, it hit its profit objective at 15,523 last year. But we also have a bearish flag at this point form with a, let me just extend the chart, with a pattern profit objective as far south as 7,674. Now, I can almost feel some people, some will say, no way will Bitcoin reach that far south. Now, if I said to you at 60,000, 65,000, we'll be talking, as we head into 2023, we'll be talking about Bitcoin below 20,000. You would have thought the same. So while I do not believe we will reach this far south, it's certainly not out of the question given the movement I've seen and what the charts are telling me. So right now we are still in a downtrend. And for me, this is still a sell on rally market. So I will be closely watching this resistance, as I said, at 18,099, followed by the 20,000 threshold, which was widely talked about in late 2022, and also this 200-day simple moving average, which converges closely with that psychological number. Another resistance, of course, to be aware of is the 21,924 level. Also, do note that we are now in overbought territory, and we have not been in overbought territory. I will discount this one because we just basically clipped the lower edge. We have not been within the upper area of the overbought territory since October 2021. So this is quite a big deal. Also, for any harmonic traders watching, we have, I believe, a near AB equals CD correction. Let me just... So we have A, B, C, D, and we are now within very close range of testing that level. So this is, as I said, this is for me is a sell on rally market right now. Could Bitcoin recover and rally to the upside? Of course it could, but right now the technicals are telling me we should be prepared for another year of bearish, another couple of months at least bearish plays. All right, so I think that's really it. Let me just okay, right, any questions, guys? Okay, right, so look, the next webinar for this month will be on the 26th of January. And this is the title of this is Trading Strategies for Beginners, and it's news trading. And what we're going to try and explain here is what news trading is news trading right for you, and how to create a news strategy. And this will be at the same time of 9 a.m. GMT. If there are any specific comments or feedback or any questions regarding today's presentation, you can use the following emails, either support@fpmarkets.com or marketanalyst@fpmarkets.com. I would advise you to use this one if you want to get in touch with the research team, because it's far quicker and you'll receive a response in a more timely fashion. Also, feel free to check out the FP Markets Trading Hub. This has been live for a while now. It's packed. I was talking about the Trading Academy there. Bear with me. The FP Markets Trading Hub is packed with educational articles and daily and weekly analysis. Now, the Trading Academy has been up and running for quite some time now. It has a number of videos, a number of in-depth articles, and really helps new traders immerse themselves into into the wonderful world of trading and investing. All the links will be in the chat box, guys. Just as a reminder, there will be a recording of this presentation available either through YouTube or sorry, as well as on our website. One final check for any questions. Okay. You're very welcome, Travis. Excellent. All the best for 2023, my friend. All right. So this is pretty much all we have time for today. Thanks once again for taking the time to join. I hope you are able to walk away slightly more informed than when you joined, especially as we head into what could be potentially a tumultuous 2023. Thank you very much, and I'll catch you all again very soon.